Well, super excited about tonight's topic. As a trader myself, it's always a tough decision when you're getting close to a stop loss or something, and you decide to hang in there and think you'll be right, and the trade continues to run against you, and that's a big area of trading that that you need to sort of overcome in order to become successful and play to the probabilities. And what Philip will talk about tonight will give you some great insights to that. Talking about things like the 4 fears in trading, what the main ones are, and how to overcome them, and then looking at sort of rationalizing that with probability. Just before we go on to Philip, I just want to show you a little bit of a disclaimer from us. And that is, funny story. A disclaimer is actually a statement that denies something, especially responsibility. So it's just a bit of a warning. Everything in tonight's presentation will be general advice. We don't know who you are or your circumstances. So if you are thinking of acting on any of this, please do a bit of research, see a specialist if need be, and just be responsible in the risks that you're taking on. The examples provided in this presentation are examples only. They'll generally use historic data, historic trades. We all know that future financial performance may not always reflect those historic trends and patterns. I'm sure most of you know we use leverage in some of our products. This amplifies both profits and losses, and so you should be aware of this if you are trading on leverage. Enough of the formalities. I will now hand over to Philip, who's going to take you through tonight's webinar. Just bear with me one sec.
Thank you, Julian.
No problem. Evening, Philip. Hope you're doing well.
Excellent tonight, and looking forward to talk about one of my favorite topics, which is psychology.
Great.
So once again, before we start, I have to do my own little formalities. This is my disclaimer, just stating that everything I will be talking about is educational purposes only. And let's just get right into it. Okay, so today I am talking about the 4 fears of trading. Why is psychology one of my favorite topics? It's because it is probably one of the most overlooked, and it is probably the most important, I would say. Why is that? Because everybody, as soon as they're getting into trading or they're learning how to trade, they're focusing so much on the charts, on the candles, prices, indicators, because they think that's what trading is all about. And what they do is they seem to kind of leave behind all the psychology aspect, where in reality, psychology is what runs trading. Your mindset, you as a person, the way you're thinking, the way you're entering, exiting trades, all these things are what make up trading. Trading in itself is extremely simple. Hitting a buy or a sell is very simple, easy to do. And the reality is you're going to either be right or wrong, because there's only two options, which is you're going to be on the right side of the trade or the wrong side of the trade. Now, the in-between is what's important. Holding the trade before entering the trade. What happens as you're approaching a stop loss, as Julian said, or as you're approaching a TP? Are you going to become greedy and move your TP even further? So today I want to focus on one aspect, which is the 4 fears of trading. And if you guys have an understanding on the 4 fears, I believe these can help you in your own personal journey through trading. So what are the 4 fears of trading? We're going to look at them. The 4 of them are, so we have the fear of losing money is the first. The fear of being wrong. The fear of leaving money on the table. And the fear of missing out, which is FOMO. And I reckon every single one of us has gone through the FOMO in trading. So the first one I'm going to talk about is the fear of losing money. So everybody gets into trading and they have this fear when they're entering a trade that they're going to lose that trade. And ultimately what that is doing is you are mentally preparing yourself for a failure, you could say. You're pre-programming your mind as a failure for the trade, and you're worried about losing money. Now, the worry of losing money on the trade is only going to create more problems down the line. What do I mean by that? Is let's say you enter a trade, you've set a $200 stop loss on that trade. Now, let's say before you enter that trade, you're in fear that you're going to lose that $200 because you need it, or you're risking more than you should. So you have that fear of losing that money before the trade even plays out. So that's leaving you with an unlimited amount of options of what could possibly further go wrong, such as when it's approaching the stop loss, approaching TP, as it's hovering, whatever it's doing, you are already in that mind state of fear. So we need to remove the fear of losing money. Hence why it is always said that trading should be done with capital that you can afford to lose, with capital that you're comfortable with. Risk management is talking about the money that you're not going to fear losing on a particular trade. So that's the first fear that I want to talk about, which is the one of losing money. The second fear is the fear of being wrong. Ego is extremely important in trading. So it plays a critical role. And I say that one that can't leave their ego and emotions outside of trading is going to be immensely affected by it. A lot of people that come into trading and they think that they can be perfectionists. And sooner or later, they discover that you cannot be a perfectionist in trading, because the reality is nobody can just hit every single trade correctly. There's going to come a time where you're going to hit a wrong trade. That's the reality of trading. There's winners and there's losers, and it's very normal to get a losing trade. So the person that comes in with the ego or the emotions that they believe they can't be wrong, they have that belief, and that usually is generated from outside, from life itself. And I'll explain to you guys how. When we look at life and the way we were raised in the general, you could say through school and through the workforce in any career, it has always been instilled in us to believe that winning is good and losing is bad. So when you look back at, let's say, your sports games at schools, your game of footy, if you lose the game, it's usually considered a bad thing. And if you win the game, it's considered a great thing. Same as exams. If you fail an exam, it's bad. And if you pass an exam, it's good. Then you go into the workforce where you have the exact same thing happen. In any particular job, in any particular career, you're kind of expected to know what's going to happen next. You're expected to know the outcomes of certain events, and that's how your work is done. You can't leave your work to uncertainty. That's not how you could say your general careers work. So people go from careers like that and they come into trading, which is a career of itself. However, I believe it's in a whole completely different league of its own. So people come into it and they have the same brain, you could say they're being wired to work and believe in one way. Come into trading and they try to actually implement the same tactics into trading, where they are trying to know what's going to happen next. They're trying to find the outcomes of scenarios before they happen. They cannot be wrong because they have been so used to not making mistakes. What happens once you put that into trading? It just simply doesn't work well. You find people failing in trading by trying so hard to succeed. So ultimately, it's trying to succeed that makes them fail, because they don't have that understanding. And that's what I'm trying to teach you today is you cannot look at trading the same way you look at any other job. You have to rewire your brain in order to understand that losses are okay. winning is seen the same as losing in trading. You got to be completely emotionless in what you do and completely emotionless in your trades to the point that you cannot, I would say you cannot celebrate your wins and you cannot celebrate your losses. And that is why they say you have to trade like a robot. Because in the ego and the fear of being wrong, this is another thing that can come. Let's say you have an amazing trading week and you've made X amount. Let's say you made $1,000 this week. Next week comes along and let's say you got very excited. You have attached that emotion of excitement, of euphoria into that week. Comes the next week, and let's say you make 750. You should be very content with what you did because one, you're in a positive, and two, it was almost as much as you made last week, and you were very ecstatic about it last week. But now there's going to be those emotions that you attached to that $1,000. And what that's going to do is your brain is going to fire all these thoughts that are telling you, you didn't do good enough this week. You haven't done well. You didn't do as well as you did last week. You did 1,000 last week, as if you can't do more. So unintentionally, you are working against yourself. Trading is all about you against you. And that's something very, very important that you have to remember. It is you against yourself. Now, you've attached these emotions, comes this week, you should be very content. You're not content. What happens? Mistakes come. You can over leverage. You start looking for trades when there is no trades. You're veering off your strategy. You're taking trades, you're moving your stop losses. Why? Because you have that fear of being wrong. You don't want to be wrong. You want to be right. You've attached that feeling of excitement. You want that feeling again. You cannot accept that this week might not have as many opportunities as the week before. So then that fear of being wrong has completely sabotaged your own success. One thing you need to remember is the market is never against you, because there's always two people on every side. When you're in, let's say you're in one side of the trade, you're in a buy and you're running in the negative, you cannot say the market is against you. Why? Because there's someone that's in a sell and the market's with them. So they can't say the market's with me or the market's against me. You have to look at the market, it's completely neutral. The market is just a bunch of ticks and information moving up and down. Your job is to understand that the market is neutral. And you have to understand that by the market being neutral, you're going to be in some scenarios where you're going to be on the wrong side of the trade. And you shouldn't have that fear of being on the wrong side of the trade. That's where that whole concept of probability comes in that we're going to discuss soon. Now, the next one's actually a funny one because it's the fear of leaving money on the table. And this fear isn't actually generated by losses. This fear is actually generated by being in positive. So how does that work is, how many times have you been in a trade where you've entered a position and you've set a TP, let's say you've set it at $1,000, you see your positions running in plus $100, and then you start thinking, that's $100, maybe I should take it. Should I take it now? I could really use that money. You end up taking it because you had that fear of leaving that money on the table, and then only for you to return 10, 15 hours later, and you see that your trade would have hit full TP. I reckon the majority of you would have experienced that. And the reason for that is, and I'll explain to you why you're going through things like that. The reason for that is because you are probably trading more than you should. And why do I say that? You're probably taking positions larger than you should. Why I say that is because if you're looking at the $100 as something you need to take and you can utilize it, then you aiming for 1,000 is probably a bit too much. So in saying that, that's where the whole concept of your risk management, because risk management ties in extremely closely with your psychology. They work hand in hand, because your risk management is your psychology. If you're risking too much, it's going to affect your psychology. And if you got your psychology on point, then you're going to have your risk management on point. They work hand in hand. So the fear of leaving money on the table is a fear generated by profits. So that's now, as I was explaining to you before, we come from a place where we are told we need to wake up, we go to work, work generates money for us. If you tell a common person, I went to work today and I had to pay money to go to work, they would think you're absolutely nuts. When the reality is, in trading, that's completely normal. So unless you start really and truly understanding that these concepts are normal and these concepts are what trading is all about, you're always going to be thinking from the outside perspective, which is outside trading. And that's what's going to set you up to have all those fears and failures. So once we see that we're in positive and we start thinking, should I take that money? I don't want to leave it on the table. That's because we are associating our thoughts with we need to be on the positive side for today. In doing that, look, it's probably not a bad thing that you took out a portion of your profits rather than your full TP. I mean, it's not bad that you took $100 instead of 1,000. But in doing that, what that is affecting is, yes, it might sound okay in one instance. But then when we start looking at the probability aspect, where we're looking at the course of hundreds of trades, and we've got a strategy that's hitting an X amount of percentage of successful trades, and we're working with risk to reward ratios. When we do that, we're actually affecting our strategy and we're affecting our statistics a lot. Because if you look at it as you lost the 2 previous trades, and let's say you're down 2% from those 2 trades. Now, what's going to happen is you took this trade, and this trade was the one that says meant to be the positive trade, and you took 1%. It was a 2-to-1 type of trade. You, at full TP, you would have got 2%. You would have made all your losses back from that one trade. By having the fear of leaving the money on the table, what you've ultimately done is you've cut yourself short. You probably took out 0.1% of that trade, or 0.2%. You didn't make your losses back. And now that one trade, let's say you've got a 70% success strategy or 60%, that one trade out of those 10 that is successful, you didn't use it to your advantage. And you can now see how, if we're looking at it as a chain, when the next trade comes along, if that's a losing one, it's just going to start going downhill. If every time we are in a little bit of profit, we're going to be thinking, I want to get out. I want to take it and get out. Because we're affecting the overall process. Trading is not about an individual trade. It's not about just one trade. Trading is all about probabilities and a long-term strategy with a long-term success rate. That's what it's about. We're not looking at one trade. We're looking at thousands of trades. That's what trading is all about. And that's why your success shouldn't be assessed on a week. You shouldn't say, oh, I did amazing this week. You should be assessing yourself on a monthly or quarterly basis, because it's the long term that we care about. That's what we're interested in. So that pretty much is the fear of leaving money on the table. That's what it's about. And overcoming it is the true understanding of probabilities and the true understanding that this might be the trade to save us from, or let us recover from our losses, and understanding that it's okay to have winners or losers on any particular day in trading. And then the last fear that we have is known as the fear of missing out. So what's the fear of missing out? The fear of missing out, FOMO, is traders entering trades too early, too late, and pretty much without confirmations, without their strategy, purely based on the fact that they think they are missing out if they don't get in. And that's something that's extremely common. I've heard traders talk about it all the time. I myself have gone through it many, many times, especially when I was first getting started in trading. It's because you think that you're going to miss opportunities if you don't get in. When the reality is, in trading, trades are always available. There's always another trade around the corner. There's always a new trade that's going to come up. And if you have a strategy, and if you've developed and you truly believe in yourself and in your strategy, you should never have that fear of missing out, because you would truly understand that the next trade is coming. The whole idea of FX trading is, one of the main advantages is the freedom that it possesses. On days you want to trade, you can. On days you don't have to. So you missing a trade is the same as having a day off. On the days off, you are probably missing out on a lot of trades. You don't worry about them because you intentionally set your mind to have a day off. Whereas when you're trading, if you've missed an opportunity, you should look at it in the same way, that you've intentionally now don't want to take it because it's too late. Where your mind and your brain's going to start playing the tricks and trying to convince you that you should still get in. You should get in because your mind will start tricking you and showing you, you could say, confluences that are not really there, or trying to pretty much just try and convince you that it's not too late to get in. So then this is a quote that I want to explain to you, because I believe every single one of us has gone through this. And it says, fear narrows your perception. You'll focus on the fear so much that you often create the experience you are trying to avoid. So what does that mean? What does it mean? I'm going to say it again. Fear narrows your perception. You'll focus on the fear so much that you'll often create the experience you are trying to avoid. When we are looking at the charts through fear, we are narrowing our perception. And by focusing on that fear so much, our perception is so narrow that we create the scenario that we don't want to happen. This is an example of what I mean by that. You have an uptrending channel on a chart like this. You see you've got your low, your high, your low, your high, and you see that the market, you've got a trend line. You see the market rejected at this point right there, created this nice hammer pin bar. You've got your moving averages that you're finding some sort of a support on. And you've got your fib, let's say, you're taking it based on that 78. You take a trade here, you enter into a buy, you're aiming for the highs, you put your stop loss below the previous low, let's say. The market starts moving against you. As it's moving down, moving down, moving down. The fear at this point is narrowing your perception so much that every time the market moves down, every time it ticks down, you're seeing that as a threat. And every time the market ticks up, you're seeing that as some sort of, you could say, as exciting or as a positive. As the market starts approaching your stop loss and you're now perceiving threat more and more, Your stop loss is down here. What do? Some people might say, oh, I'm going to move my stop loss slightly down because I think it's going to bounce. We've got a support right there. So move your stop. You see the market starts bouncing back up. So now these upticks start giving you that excitement because you're like, okay, I was right. I wasn't wrong. When in reality, that's all fear talking. Because as I said before, trading shouldn't have emotions. Emotions, whether positive or negative, are not good. So now you start moving to the upside. You see that you're back at break even where you entered your position. And you're like, all right, that was just a fake out. That was a liquidity grab below that low. It's going to go up from here. Market starts moving back down. You're now back into that fear thinking. Market starts moving down. You've got your stop loss down here. Bounces up. You're like, no problem, still safe. Market comes down, starts getting closer to your stop loss. You decide to move it because you're like, oh, there's another area down here. There's a support right here. I'm going to move it below it. What you've done, and this is back to the quote of the fear narrowing your perception. You haven't actually realized that the whole market has shifted from an uptrend into a downtrend purely because you were so focused. And usually what happens, it's not until you get out of the trade, whether you close the trade yourself or you blow an account or you've let it run that far that you get margin called. It's not until you're completely out that your perception comes back and you look at the chart and you're like, how did I not see that? How did I not see that we completely shifted and we started creating lower highs and lower lows? And in reality is entering a trade here, letting it stop out here. That was another area of support. You could have taken a trade here up into here. That was another area of support. You could have taken a trade from here up into here. But because you let fear narrow your perception that much, you got stuck with one, the fear of losing the money, two, the fear of being wrong because you just couldn't accept being wrong. And you let the trade move against you so much, your perception was that affected by the fear that it's not until you're out of the trade that you notice it. And honestly, I think the majority of you guys would have experienced something similar. And now I'm explaining to you all these underlying reasons as to why. And hopefully by knowing these things, that's what's going to help you improve to spot what you're doing wrong. Because the reality is you don't actually know what you're doing until you're out of the trade. And that's based on that quote. So how do we remove that fear from trading? The first thing we need to do is, it's easier said than done, is to be completely at peace with losing a trade. You need to actually be the type of trader that if a trade hits your stop loss, you can look at it without anger, without any negative emotions, accept it and say in your head, I'm confident in my strategy, I'll make this back. And many of you guys who are part of my groups, you see me, I hit stop losses. Some of my trades hit stop losses and I always say, we will recover. And that is because I truly am confident in my strategy and in myself. Now, there's a difference between euphoria and confidence, and I want you to be very, very aware of that. Euphoria is when people make quick money. They get trades right that they weren't expecting to get right. They over leverage and they make a large sum of money in one hit and they get euphoric. Euphoria usually leads to failure because people start chasing the euphoria. They think they can replicate what they've done numerous times, and sooner or later, the failure is going to be around the corner because they're not approaching trading from a confidence, from a strategic point of view. Confidence, on the other hand, is having complete belief and trust in your strategy. You know that if you took a loss, you're at peace with it, you're going to make it back in the following trades. The next one we need to know the difference. So I just explained the difference between confidence and euphoria. Next one is understand what it means to think in probabilities. I want you to imagine this. Think of yourself throwing a coin 10 times. Now, the possibilities are going to be heads or tails. Or tossing a coin 10 times. Let's say you toss a coin 10,000 times. And I tell you, I want you to pick a random sequence of 10 consecutive throws from anywhere in that 10,000. And I want you to tell me, would you know if it's going to be heads or tails for those 10 consecutive? You would have no idea. You'd know it's going to be one of the two, but the sequence of those 10, whether it was heads, tails, heads, you wouldn't know, because it can be anything. It's completely random. You have to look at your trading in the exact same way. You have either winners or losers. Now, the only difference between tossing a coin and your trading is if you've built a strategy that has a success rate of over 50%, that's how you have an edge. That's how you put the odds in your favor. So now, if you know that you've got a 7 out of 10 winning strategy, and let's say you have 10 trades. Do you know where those losses are going to lie? No. Your loss can be your first trade. Your loss can be your last trade. It can be in the middle. You don't know. So over leveraging, over risking is one of the reasons now that you should understand why you shouldn't do, because you don't know where that loss lies in that 10. And you don't know where your winner lies in that 10 either. If you have 4 wins in a row, sometimes people can get overly excited, euphoric, and they might say, "Oh, I'm on a run. I'm gonna risk 3 times what I normally risk on the next trade," not knowing that the next trade is their losing trade in that sequence. So once you understand how probability works, which is in that way, you understand why you should be acting as a robot, you could say, in your trading. Emotionless, following a strategy, not deviating from it, accepting losses, truly accepting losses, being at peace with them, because you know the winners in that sequence are going to come, and they're going to come more than these losers. Next point is believe deeply at any time that anything can happen. The market doesn't need to do what you think, doesn't do what any of us think. The reality is anything can happen at any time. Yes, we look at historical data. Yes, we look at patterns, we look at indicators, but just because something has happened in the past, it doesn't guarantee that it's going to happen in the future. All those things do is give us an edge, meaning it's giving us more of a possibility, more of a probability that it will happen than it won't. But the market in that moment can do anything it likes. It does not have to do it just because it has previously done it. After a head and shoulders, people say the market's going to drop. You start seeing a head and shoulder forming. Doesn't mean the market has to drop. So the belief of that deeply, that anytime anything can happen, is extremely important. And that ties into the next one, which is every moment is unique. Meaning nothing is ever going to be replicated on the charts. No 2 moments are exactly the same on the charts. Patterns, indicators, even certain moves that happen, they can be similar, but they will not be identical. Every moment is unique. The market's always behaving in a unique way. The market's constantly changing. And us as traders, we are constantly adapting. Now, understanding all these things, how do we need to do them? Well, that then comes down to rewiring our brain. So the way I like to do that is through reflection, you could say. Reflection, journaling, meditation, deep understanding, so noting down everything and repeating these things. They say it takes 21 days to form a new habit. You can do the things that you need to do, reinforce them into your mindset. Start understanding that the career and the pathway of trading is unlike any other job or career. Once you start really instilling that into your mindset, you will rewire your thinking. So that way, when you sit on the charts, when you sit to trade, you're understanding that all the other things that you've learned through life don't apply here. This is a new thing. It's a whole new league of its own. They don't apply in this instance. Winning is not a good thing and losing is not a bad thing here. I've rewired my brain to truly understand that this is different. So that pretty much wraps up the 4 Fears of trading, the probabilities, understanding these concepts. I honestly hope that every single one of you guys in here, or the guys listening to this, will take something out of this, because I truly believe psychology is one of the most overlooked yet most important topics in trading. I believe all my personal success has come once I really took an initiative to dive deeply into understanding my own psychology and improving it. So I just let you guys, honestly, if you have anything to say now, please feel free to do so. I want to thank you all for attending, for listening to me. And if you have any questions, this is your chance to ask me. I'll be more than happy to answer them for you guys.
Thanks, Philip. I think that was one of my favourite webinars so far. I know a lot of you who are probably listening out there have seen a crypto run or a stock run or a currency run, and get that FOMO and break all your rules, enter the trade, follow the herd, only to pick the top or pick the bottom if you're shorting. So it's very valuable to have tools to deal with that sort of stuff and stay disciplined. So I think you went a long way to really tell us how to do that, Philip. So thanks very much. Any questions? Simply put them in the question window. We will endeavour to come back to you. So if there are any questions, bring them out now. Otherwise, hold your peace, and you can reach us on email. So if you want to contact FairMarkets, it's support@fair.markets. And Philip, what's the best email to get you on if the guys have any questions?
Just Philip with one L, so PHILIP @opestradinggroup.com.
All right, doesn't really look like there's any questions. Another really great session. These will all be on demand through the FairMarkets website. So check them out at your own time. That one probably definitely worth watching again and again.
I'd just like to add, if there's anyone in here from Sydney, FairMarkets is hosting an event. I'll be the presenter. We have an event this Saturday at their office in Sydney City. If any of you are in here are from Sydney, would love to have you down. I'd love to get to meet you. We're going to be running through a lot of trading, a lot of basics, intermediate, strategy building, more psychology, diving into psychology. It's going to be a great event. So if any of you can make it, please contact us also for that.
Yeah, big event. Also doing some catering. It's 9
Any books on
12:30. 1 Blythe Street in the city. Yep.
Yeah.
So yeah, it'll be a cracking event. The first of many.
Perfect. I believe we have a question on any books on psychology, yes, I can recommend the book. It is called, so there's one called Becoming Supernatural by Joe Dispenza that really helped me. There's one called Breaking the Habit of Being Yourself. So that will really help you in rewiring, you could say, understanding how to rewire your brain into new thinking or new things you want to do. It's definitely a book I would recommend. And there's a book by Vivan K. Tharp. I believe it's called Trading Beyond the Matrix. That's what it's called. Trading Beyond the Matrix. So those 3 books I would recommend to you guys. And yeah, if you have any other questions, just feel free to contact us after this. Thanks all for attending. Julian, thanks once again for having me on here. It's a pleasure. Hope everyone enjoyed it.
Fantastic. Thanks, guys. And Philip, have a great night.
Thank you.
Bye.